Welcome to the Deep Dive. We're jumping straight into Main Street Capital, ticker MAIN, and their Q3 2025 earnings call.
Yep, the call happened midday November 7th, right after the numbers dropped.
Yeah.
And the big question for us is how management navigated what was, a pretty complicated quarter.
Complicated is the right word, because the stock went up almost 3%, but the headline numbers, they didn't look great at first glance.
Not at all. And that's really the core conflict here, the sort of split personality in the results.
Okay, so let's break that down. The standard number, the GAAP net investment income, that was a miss, right?
The pretty significant miss, yeah. It came in at 97 cents a share when consensus was looking for something like $1.04. So, that's nearly a 7% miss.
And for most companies, that would have been a bad day.
Very bad day. But Main Street investors, they're trained to look past that number. They focus on something else entirely.
The DNII, the distributable net investment income.
Exactly, the DNII. And it's so critical to understand this distinction. It basically tells you the actual cash that the company generated to pay out its dividends.
So it strips out some of the non-cash noise.
Right. And on that metric, the one that really matters for dividend coverage, they crushed it.
Okay, so what was that number?
DNII landed at $1.03 per share.
That was you.
The street was hovering right around $1, so that's a solid 3 to 5% beat where it counts.
So the market just completely ignored the GAAP miss and focused on the cash flow.
They did, but it wasn't just that. There was another anchor, something that gave investors real confidence in the, long-term health of the business.
The net asset value.
The NAV. It hit a record, $32.78 per share.
Mm-hmm.
When you see NAV climbing like that quarter after quarter, it signals that they're actually creating fundamental value. It's not just an income story.
And what about the profitability? I mean, to justify their premium valuation, the returns have to be there.
Oh, they were there. The annualized return on equity for Q3 was 17%.
So right in that high teens sweet spot they need to be in.
Exactly. And the trailing 12 months was even better at 19%. That ROE number basically told the market, look, the quarter was a little messy, but the core engine is running hotter than ever.
Okay, so let's dig into that engine. How did they generate that strong DNII beat? It comes back to their special sauce, doesn't it? The lower middle market.
It always does. Their LMM portfolio, that's their differentiated strategy. It saw a net increase of $61 million in the quarter.
And that segment is what gives them higher yields than those equity kickers.
Precisely. That's where they get the dividend income and the unrealized gains that, most other BDCs just can't replicate at that scale.
But at the same time, their other big segment, the private loan portfolio, actually shrank.
It did, yeah. It saw a net decrease of $69 million.
So is that a red flag? Does that mean the broader lending market is cooling off?
Well, management said it was really two things. First, they had higher than expected repayments, which is, a good problem to have.
Okay.
And second, just a timing issue. A few large deals that were supposed to close in late Q3 slipped into the first few weeks of Q4. So it sounds more like a temporary blip.
Got it. And a big part of the story for Main Street has always been their cost structure. How did that hold up?
Rock solid. I mean, they continue to be incredibly efficient. Their operating expenses to average assets came in at just 1.4% for the quarter. That is truly industry leading.
And that efficiency flows right down to the bottom line, to that DNII number.
It's a huge structural advantage.
All right, let's talk credit. Because no matter how good the model is, it all comes down to credit quality.
Yeah.
Management's tone was pretty positive.
It was. They said the portfolio is performing at a high level, and the main stat backs that up. Non-accruals, the loans that aren't paying interest, are still very low, just 1.2% of the portfolio's fair value.
But, and this is a big but, we can't just gloss over the realized losses. There was a big number in there.
You're right, you can't. They took $19.1 million in net realized losses this quarter.
That's a chunky number. What happened there?
It came from restructuring 2 of their private loan investments and then fully exiting 2 of their LMM companies. So a realized loss means they basically sold or restructured for less than they paid.
Restructuring is usually a bad word. It implies those businesses were in some kind of distress.
It does. It means they had to take a haircut to, keep things afloat. It's a reminder that even the best managers aren't immune to a tough macro environment.
Do they offer anything to soften that blow?
They did. They immediately pointed to the future, saying they expect to generate at least $35 million in realized gains from 2 other exits that are planned for Q4 or early next year. So, trading a current loss for a future gain.
It's a pattern this quarter.
Mm-hmm.
Short-term pain, long-term confidence. And speaking of long-term, let's talk about their balance sheet. They seem to be building a fortress.
They really are. They issued $350 million in new notes and used that cash to pay off some debt that was coming due in 2025. Super proactive.
And the result of all that?
The result is they are sitting on a mountain of cash. They ended the quarter with $1.56 billion in liquidity.
Wow. Over $1.5 billion in dry powder. So their leverage must be incredibly low.
Extremely low. Just 0.62x debt to equity. And management was very clear. They planned to run below their normal target range for a while because of, and they said this specifically, macro uncertainty.
So here's the big debate, right? They're saying the deal pipeline is above average, but they're also hoarding cash and keeping leverage low.
It's the multi-billion-dollar question. Are they being overly cautious, which could, hold back NII growth? Or are they getting ready to go on offense if the market turns down and they can buy assets on the cheap?
A question we'll be watching. Now let's pivot to the thing that really moved the stock, the dividends. For an income investor, this is everything.
This is the bedrock. In Q3, they paid out over $1 a share in total, including their supplemental. But the big news was all about the future.
They didn't just maintain the dividend, they raised it and telegraphed even more to come.
They did. They boosted their regular monthly dividend to 26 cents a share for the first quarter of 2026. That's a 4% year-over-year hike. And then they declared another 30-cent supplemental for December.
And the CFO basically put a floor under the next quarter's earnings, right?
He did, guided for Q4 DNII of at least $1.05 per share, and he even hinted at potential upside. That provides massive coverage for the regular dividend.
But the real kicker was the signal about March.
That was the knockout punch. Management said they intend to recommend an additional significant supplemental dividend for March. They are essentially pre-committing to a very generous payout for the next 6 months.
That kind of confidence has to be backed by a strong pipeline of new deals. Did they give any color on that?
Yeah, the tone was really optimistic. They called both the LMM and the private loan pipelines above average. They're seeing more deals, bigger deals, and, deals that are more likely to actually close.
And it's not just about finding new companies, right? They talked about creating value inside the ones they already own.
Right. That president's meeting they hold every year. It's a great example of how they work to justify that premium valuation.
What was the focus this year?
2 big themes: using AI to drive efficiency gains and finding smaller add-on acquisitions for their portfolio companies to buy. They're not just passive lenders, they are active owners trying to improve these businesses.
We should also touch on their asset management business.
Yeah.
It's a kind of under-the-radar growth story.
It is. It kicked in almost $9 million to NII this quarter. But the big catalyst is their largest client, the MSC Income Fund.
Okay, what's happening there?
At the end of January 2026, that fund gets a big regulatory green light to take on more debt.
And in plain English, that means what for Main Street?
It means more assets under management for that fund, which means more management fees flowing directly back to Main Street's bottom line. It's almost like, pre-programmed growth.
This all sounds incredibly positive. So let's get to the friction point. Why has the stock been a little weak recently, despite all this good news? We have to talk about the valuation.
This is the core tension. Yes, they've outperformed over the last year, but more recently, they've actually lagged the broader BDC sector.
Which suggests that sector-wide anxiety about credit is finally starting to weigh on even the best-in-class names.
I think that's right. And it all comes down to the premium. The stock trades at roughly 1.7 times its net asset value.
1.7. That is a massive premium when most of their peers are trading right around book value or even below it.
It's enormous. And what that means is you, as an investor, are paying nearly double what the company's assets are worth on paper. To justify that, they have to be perfect.
No room for error. No more $19 million realized losses.
Exactly. They have to keep that ROE in the high teens, keep non-accrual super low, and keep raising that dividend like clockwork. Any slip up, and that premium is at risk.
So the next few quarters are all about execution. Can they put that $1.5 billion to work and convert that strong pipeline?
That is the whole game. If DNII comes in at or above that 105 floor and they start deploying capital, the premium probably holds. If not, that 1.7x multiple is going to feel very, very heavy. Which brings us, of course, to our segment where we have to say, this is not financial advice. We are just kicking around an idea, something you might hear in a hedge fund meeting.
Do your own research. This is purely for educational and entertainment purposes.
So the thesis here is built entirely on that valuation tension. Main Street is a fantastic company, maybe the best in the space. But 1.7 times book is a stretch multiple in any environment, let alone the current one.
So the bet is on gravity, on valuation convergence. How do you trade that?
You set up a pair trade. You go short Main Street, ticker MAIN, and you go long the BDC ETF, ticker BIZD.
Okay, so why not just short Main outright if you think the valuation is too high?
Because a straight short is incredibly risky here. Management just handed you a clear catalyst with that March supplemental dividend guidance. That could easily squeeze a short position.
So by pairing it with a long on the whole sector, you're neutralizing some of that market risk.
Exactly. It becomes a relative value trade. You're not betting on a disaster at Main Street. You're simply betting that the massive valuation gap between Main and the rest of the sector will close a little bit.
So even if Main performs perfectly, you can still win if its multiple just comes down a little, say from 1.7x to 1.5x, faster than the rest of the sector recovers.
Precisely. You're betting on valuation gravity against a best-in-class asset. A tough bet, but a plausible one.
Valuation gravity, a powerful force. This has been a really fascinating look at a quarter that had a lot of moving parts.
The key takeaway for you listening is this. The market looked right through that headline, NII miss. It focused on the things that drive long-term value. The record NAV, the strong ROE, and that super reliable dividend growth.
Which leaves us with that final strategic question. Management says they're being conservative, holding over $1.5 billion in cash because of macro uncertainty.
So the question you have to ask yourself for the next 6 months is this. Is that massive pile of cash a defensive move that's going to be a drag on earnings if the economy stays strong? Or is it an offensive war chest ready to be deployed to buy great assets at cheap prices if we see some real volatility?
That balance between defense and offense is what will define their story in 2026.
It really is.
A fascinating puzzle to watch unfold. Thanks for joining us for this deep dive into the Main Street Capital results. We always encourage you to review your own notes and research.